I love being able to bring people an understanding of how the market works, bring people an understanding that they can make money in the stock market. It's not a mystical thing. It's not just for a certain group of people. It's for anybody and everybody. And I know that a lot of people here are gamers. But if you have any inclination about wanting to join the market and get on board with generating another stream of income, the market may be a way to do it. And am I going to tell you that you're going to get rich overnight? No. Am I going to tell you that VectorVest has a magic pill to get you rich overnight? No. But if you're willing to put together a trading plan and understand what's going on, let us walk you through that process, then VectorVest is for you. We're not a broker, so you can't trade through us. But the VectorVest tool is designed to help you to make better decisions in the stocks that you buy and sell. It also is big key thing. It's going to help you to know when it's okay to buy stocks. You may hear on TV or in another live stream that, hey, ABC stock is the stock, it's hot, go buy it now. Well, you can blindly buy it and hope that you make money, or you can use a tool like VectorVest, which will help you confirm if that's really a stock to buy or not. And that's the power and the benefit of having the software. Nobody's going to spend money on anything that does not benefit them. I can assure you that VectorVest will benefit you in ways that you can't even imagine right now. All right, being able to not only make money in the market, but to consistently make money in the market, that's a huge benefit. Yes, many of you might have dipped your toe in the water as far as investing goes. You might have made a couple of trades, they didn't make any money, you got discouraged. Maybe some of you have dipped your toe in the water, you made a trade and it worked, and now you're like, man, I'm a genius. Well, we're going to take the best of both of those worlds and combine it into something that you can consistently make money in. Are you going to make money on every trade? No. Will you outperform the market? We can show you how to consistently outperform the market. Am I going to be able to make big money on stocks? There's going to be opportunities where you can do that. Will I show you, or will we show you how to lose the least amount of money you can on a position? Yes, we will. And our support staff is here to answer any questions that you have. I would like to say that we have a world-class support department that will walk you through any aspect of the software. Any aspect of the software. All right, so a lot of free training we give, a lot of videos that talk about the software that are free that we give. So if you ever decide to join VectorVest, we don't just throw you to the wolves and say that this is baptism by fire. We walk you through what you need to do. And because we're not, keep in mind though, we're not brokers or we're not money managers, we can't tell you exactly what stock to buy or sell. We're not licensed to do that. But we're going to put into your hands the power and the flexibility for you as an individual to make money in the market. And I think that that's probably more in tune with the average investor in the market. They want to be able to control their own destiny. They want to be able to do what they do to grow their own portfolio. And that's what we're going to provide for you. So a lot of training we give you is free. We have paid trainings as well. I do a lot of the paid training. So for like $95 an hour, if there's a specific topic that you want to delve into, you'll get a call from me, or you'll set up a training, you'll get a call from me. And if need be, we will set up a detailed training to answer any specific questions you have outside of what we already do. So that's not, and I don't try to sell that to everybody either, because we have a lot of free resources. But if you're in need of some personal training on a specific topic, then you can pay for that and we'll help you. But before you get to that point, take advantage of the free resources that are there. We provide on a weekly basis, every week, a way of how to use the software. Depending on how you invest in the market, we have special presentations every week that will walk you through how to make money in the market. We have webcasts throughout the week that are free that will walk you through how to use and make money in the market. I personally do a weekly training that takes you through each and every tab in the software. It takes me 16 weeks to do it. But within that, actually 15 weeks. The 16th week, I actually put a trading plan in your hand depending on how you invest in the market. But the first 15 weeks takes you through each and every tab in the software. And they're already pre-recorded videos that once you become a subscriber, you have access to. Every tab in the software. So that is also another free resource. So it's not about us providing a service or providing a tool. It's about us backing it up with support. We will support you in your endeavor to make money in the market. And by far, our customer support staff is the best out there. And the only way you're going to be able to just not by taking my word, the only way you're going to be able to understand that is to sign up and have an opportunity to deal with them. They are very professional. They are very knowledgeable. And if the person you're talking to can't answer your question, there's a lot of other people around them that can. So we won't blow smoke where it doesn't belong. We're not going to tell you anything without backing it up. That's what we do. That's what this software is all about. And we're going to get you to a point that if you want to learn to make money in the market, we're going to get you to that point to do that. So whether you're a gamer or not, this is breaking into new ground, I believe, on Twitch as far as live streams that no one else has done. I've looked at some of the other Twitches that are out there about financing and something anywhere close to what we do. Nothing compares to what we do on Twitch. So you guys, in essence, are in on the ground floor of our ability to reach out to Twitchers. I guess that's a good word. If it isn't, I like it anyway. All right. So all of these live stream videos that are out here on Twitch, you're now being introduced to something outside of gaming that can better your life. That can better your life. You can now bring on an additional income by way of investing in the market. It's not as scary as what a lot of people will make you think. And it's not as hard as many people out there will make you think. One, we're going to show you consistency in being able to make money in the market. Two, we're going to simplify the process of how to effectively look at the market and make decisions on how you invest in the market. The cool thing there is everybody invests differently. We encourage that. All right, and with that, in a moment, we're going to switch you over to the Tampa 2 day. You're going to have a live look into it, and it looks like it's getting ready to start. This is a benefit for you for being a Twitcher, for being part of Twitch. We're giving you the opportunity to look into the first session of the Tampa 2 day live. All right, and pay attention. If you're not a subscriber, pay attention, get a feel of how the market works, and it's going to be presented by Steve Chappell. And at this time, I'm going to have my producer turn you over to them for the live look. This is only the one class that you're going to have a live look into, just to give you a feel, besides just listening to myself for the past few weeks. So at this time, Daniel, move them over to the Tampa 2 day, folks. Enjoy it. The Twitches that we have or the live streams that we have next week or next Wednesday and Thursday. We look forward to seeing you there. Have a great day, folks.
Gee whiz. I've been coming to Tampa now for 18 years, has it been? Oh my goodness. And for those of you that don't know, I used to actually live here in Tampa. So one of the things that I miss the most is the Cuban sandwich. You guys take that for granted, you know it? I went to a little place up in Huntersville, North Carolina. They had out on the little side street walk that they were advertising the Cuban sandwich. So I says, I got to go check this thing out. And I went inside and I said, do you guys use real Cuban bread? And she looked at me, and just kind of stared at me for a minute. And then she said, do they make fake Cuban bread? I says, I got to go to a different place. All All right, enough about that. Listen, it's so good to be here. Again, my name is Steve Chappell, Director of Trading Systems Development here at VectorVest, and we have a wonderful presentation to kick this seminar off with. It really is going to be super. It's a terrific way to set up the entire course, and if you can get a good handle on this information that we have for you right now, everything plays off of this information. It's intertwined in everything we do. And so this is an important way to start. And so if you need some coffee, go get it, because now's the time. So let's get started. Let's talk about what we need to know here first. So Myra, if you just click on the slide, and I've got a slide changer now, okay? So we're going to get into the subject of what causes bull and bear markets and when do they begin and end. And we believe that the worst thing that could happen to any investor is for them to get caught on the wrong side of the market. You know, if we think back to 2008 and 2009, the financial crisis and so forth, you know, it's true that stock markets have tended to go up over time, right? But why sit through a 30, 40, for some of you maybe 50 or 60% correction in your portfolios on that hard-earned capital that took years and years, if not decades, to accumulate, and just see it wiped away in a matter of months? It doesn't make any sense, right? And so we really need to understand how markets work. We need to understand the differences between bull and bear markets. And that's going to aid us in making a lot of our very important investment decisions on when am I supposed to be buying stocks? When should I be more protective and careful with the positions that I own, okay? And so how can we keep this from happening? You know, how can we keep from getting stuck on the wrong side of the market? Next slide. So efficient market theory. Anybody heard of efficient market theory before? Well, here's what it states. It states that all market participants receive and act on all relevant information as soon as it becomes available. All relevant information. I don't know about you guys, but it seems like I hardly ever get relevant information, right? Just get a lot of mumbo jumbo on the TV and things like that. So the real dilemma here becomes, what is relevant? Does anybody know what relevant information is? Let's take a peek. So relevant information is any economic, financial, political, geopolitical news or anything else, in other words, new products that cause share prices to rise or fall. Has anybody been following Johnson & Johnson lately? Did you see the Reuters report that came out? Turns out that their baby powder, you know, has had asbestos in it for decades, and they knew and hadn't told anybody about it. Now that would be relevant information, right? But when we as investors receive that relevant information, what's typically already happened? It's too late. So you're getting into my slide about 2 from now, but yeah, it's too late. Relevant information. But let's dive a little deeper here. So what this implies, what efficient market theory implies, is that it's impossible to beat the market, since all relevant information is already efficiently incorporated and reflected in share prices by the time we get to it, right? Anybody ever heard of random walk theory? Yeah, produced by the University of Chicago, the financial institution of the world, right? And basically what that theory states is we're all on a level playing field. We're all on a level playing field as far as relevant information. But what we'll learn next is what relevant information really does for us as investors is it compels us. That's really a key word. You almost want to circle that one. It compels us, it compels market participants to get relevant information sooner than anyone else and implement it faster than anyone else. And so you know what the big boys have done, right? The big boys have got these big computers and they set them right next to the exchanges, and guess what? They get the information first And so by the time we get it as individuals, it's too late, as you said before. Because here's an example. With Thomson Reuters, they deliver the University of Michigan's Consumer Sentiment Survey on a preferential basis, okay? And what this slide says is, if you pay for a service, or if you're an elite person or institution, you get the information first. The data is released to elite clients at 9:54 a.m. and 58 seconds. Okay? Those seconds are going to matter, you'll see. Regular paying customers at 9:55, and you got to pay for that service, and you're already late. Why? Anybody ever heard of quants and algorithmic trading? It's all they talk about on CNBC anymore, right? Well, one of the main things, right? So what's happening here is with these algorithmic trading models, they can do hundreds of thousands of trades in a split second. So those 2 seconds, that creates a pretty big window of opportunity for the big boys. And they've got enough capital where a little nickel matters, you know? You know it? So this just kind of, what I like to call this is the dilemma. You know, if what we're supposed to do is relay everything we do in terms of investing to relevant news, we have a problem. Because we're not going to be able to do it fast enough. And so what we have to do as investors is, how does the average investor cope with the situation? What we've got to do, guys, is we got to focus on the big picture. We've got to eliminate the noise, eliminate the fluff, and just focus on brass tacks and what absolutely matters. And so that's what we're going to be getting into here next, is the information that you really want to track to get a good feel for the market and to stay in tune with the market, okay? So when we look at the big picture, stock prices rise whenever the news implies that the economy is improving and earnings are rising. And I want you to underline, earnings are rising. Earnings are rising. That is the big key. That's the key thing that we want to follow, is earnings. And so at VectorVest, we follow earnings, and we followed of the S&P 500 quite closely, and many other stocks. And you'll see that as we go through the presentations. Now, earnings has a couple of enemies. And the enemies are interest and inflation. And so we're going to dive into the interplay between earnings, interest, and inflation rates, realizing that what we want to see as investors are rising earnings, but we need to pay attention to the warning signs in terms of interest and inflation to make sure that things are still checking out okay. All right? All that other stuff, hurricanes, assassinations, war, trade war, eventually will have an impact on earnings, inflation, and interest. But it's not until they do that we should really worry about them. And yet, what's happening right now? Everybody's as worried as I've certainly ever seen them in my investing career, right? So let's clear up the picture. I got a big task. I'm going to clear up the picture, but let's stay focused on the big picture while we do it. So the big picture is earnings, as we mentioned, okay? And this is a graphic taken from VectorVest. It's a little screenshot. And on the top graph, where you have the green, what we see there is the S&P 500 performance on a weekly chart going all the way back to May the 13th of 1996. And over time, what has it done? It's gone up, right? And gone up nicely. But on the bottom, what we have is earnings per share in VectorVest, okay? And the thing that I want you to understand is there is no stronger correlation in the stock market you will ever find than that of corporate earnings to stock price performance. If earnings are rising, investors like that. I don't know about you, but if I'm going to invest in a stock, I want to make sure that I'm investing in a company that's financially sound and is growing their earnings quarter after quarter after quarter, year after year after year, to know that when I put my hard-earned money into that stock, that it's got the best chance possible for price appreciation, and it's all based on this correlation here. Rising earnings leads to rising stock price in the future. It's a window into the future, and the way that we do earnings in VectorVest is different than the face value earnings you might receive on like Yahoo Finance or something like that. We look at earnings and produce a forecasted 12-month leading indication of where earnings will be a year from now. So if earnings is still rising on the very right-hand edge of the chart there, as you see, that means that the earnings are not just strong right now, they're strong for the next year into the future. And that's important information to know, isn't it? Yes. Okay? And whether it's growing faster or slower, the bottom line is, what is earnings doing? It's going up. And that's across the entire S&P 500, okay? So let's go ahead. So we have to conclude then, based upon that information, we as investors must conclude that stock prices increase with rising earnings. It was staring you right in the face on that prior slide, okay? Now we mentioned that earnings has a couple of enemies, right? And they come by way of interest and inflation. So let's look at this next chart. And this is an interesting graphic. Here we're looking at the S&P 500 PE ratio as it relates to the CPI, which is core inflation. CPI is core inflation, if you didn't know that, okay? And we're looking at January 1960 to December 2018, and you might say, well, why started 1960? That's when Dr. DeLito started investing, and he says anything before that doesn't matter, okay? So there you go. It's like he was here, just for a moment, all right? Now, what we have over on the, and you might want to follow me here a little bit. Over on the left-hand axis, here, we have S&P 500 PE ratio, okay? Over on the right-hand axis, we have the core inflation, CPI. And so we know that PE is blue and CPI is red. And the thing that I want to point out here is that when CPI rises, what happens to PE ratio? It goes down. All right, and so naturally what's happening here is if PE ratios are going down, what do we think is happening to price across the S&P? Price is going lower to create those lower PE ratios, okay? And so that's an important correlation to note, because now we know that inflation is truly an enemy of earnings. If inflation rises and begins to run rampant, what's going to happen to stock prices across the board? They're going to all begin to fall, okay? So we must conclude from that data that we just saw that stock prices decrease with rising inflation rates. And that's an important correlation, of course, to note. Here is a look at interest. Now we're looking at the S&P 500 earnings yield. We'll talk about briefly why we substitute earnings yield here versus PE. But we're looking at the S&P 500 earnings yield versus the 30-year T-bond rates. Okay, and again, this is like a 20-week average of the data even. But what we see here again is, as we look at the charts, when interest rises, earnings yield rises. And if the yield on stocks is rising, generally what's happening to the stock prices themselves if the earnings yield is going up? It's the prices are going down to create the higher yield, creating more robust earnings. It's the fact that prices are actually coming down to create that phenomenon. And so this one's a little bit more difficult to get your head around, but why use earnings yield, say, instead of PE ratio? Well, PE ratio data across 8,000 stocks is pretty wild. Particularly the lower the E goes, closer to 0 or even 0, you know, you run into situations where the numbers are, say, infinity, and it's not even useful data. So we have to substitute, or why we substituted PE ratio for earnings yield was because of that dilemma, okay? The data is just too wild. And so what we do then is we use earnings yield. And for those of you that might be struggling with earnings yield, it's the same thing as dividend yield. If a company is making $1, right, and the price is 20, 1 divided by 20 times 100 is 5%. That's a 5% yield, okay? But the important thing now to tie back the chart, and the important message is, what's happening is when earnings yield is going up, that means P is going down, price, from 20 to 18 to 17, okay? Now, as far as what we must conclude from that information is that stock prices decrease with rising interest rates, right? So earnings has two enemies, okay? And that is inflation and interest. Let me try to sum it all up. So stock prices go up when earnings go up, inflation goes down, and interest rates go down. And this is actually when stock markets thrive, is under these conditions. We call this, in VectorVest, the Goldilocks scenario. When earnings are up, interest rates are down, and inflation is down. That's the conditions where stock markets just explode and thrive, okay? So let's get back to the subject of what causes bull and bear markets. Here's what we know. What we know is that earnings, inflation, and interest rates rise in a strengthening economy. And we also know they fall in a weakening economy. What we also know is that the Federal Reserve Bank, well, it has a couple of mandates. One mandate being they have the task of maintaining monetary stability and full employment. And unfortunately for them, what we also know is that the Federal Reserve Bank seeks to maintain monetary stability by raising interest rates to cool the economy, to keep the wild card in check, to keep inflation in check, okay? They try to seek out a normal core inflation rate of 2%. Anybody know that? Okay, and so that's also kind of an important number to keep your eye on. But that's what we know. And so how does this become useful, right? We're getting to that, okay? First, one more thing that we know. The Federal Reserve Bank seeks to maintain full employment by lowering interest rates to stimulate a weak economy. We've just gone through a decade of that, right? So that should be self-evident. I mean, interest rates have been as low at historic lows for years. And what are they starting to do now? They're starting to rise. But we're still, I mean, are we seeing the days of the yield premium? Are we seeing interest rates of 10 or more? No. Okay, interest rates are still quite low on a historic basis, and I don't want to get into necessarily too much overboard into the current situation, because it is a little bit unique. But it is important you understand these things, because as interest rates continue to rise, what's that going to eventually affect? Stock prices, and what are they eventually? There's a tipping point, right? Where eventually it becomes a problem. And so the Fed has to balance these two things, and they're incompatible. It's like a teeter-totter, and it's a balancing act. And God bless them, I wouldn't want that job. You know, it's very tricky. We call it the virtuous vicious cycle. I guess that implies tricky, yeah? Dr. Delito calls this the virtuous vicious cycle, and inflation, again, is the wild card. It dictates, inflation, the reason I called it the wild card, is it dictates the Fed's interest rate policy. What are they talking about right now on CNBC? Inflation is a big subject, right? because everyone knows that interest rates are going to be a tool that the Fed uses to keep inflation in check or try to do the best job that they can. So interest rates dictate the strength of the economy. If the economy can withstand it, if the Fed feels the economy can withstand it, and inflation is starting to become a problem, what are they going to do? They're going to raise those interest rates to try to cool things down and so that it doesn't overheat, okay? The economy then dictates earnings growth. So ultimately, we want to see those earnings rising and continuing to grow in the face of those rising interest rates and so forth. Earnings growth dictates the stock price performance, which we all know now rising earnings leads to rising stock price. But in the end, what we have to conclude from all of this is that the Fed's policy dictates bull and bear markets. Okay? That's what we must be compelled to conclude from everything that we've covered so far. And so what we do in VectorVest is we track these three factors very closely. And we do that in what we call the investment climate. VectorVest monitors the level and trends. You may not realize it, but we're actually focused on trends as well of those levels, of the data. And we do so for earnings, inflation, and interest. And we compile that into something that Dr. DeLito calls the truth chart. So there are 8 cases. Here we have the truth chart. Across the top, you're going to see E for earnings, F for inflation, I for interest, and P for price action, the resulting. Think of that as the typical resulting, not typical, the resulting price action, okay? And so U is for up and D is for down. U is for up and D is for down. And what you're going to notice immediately is out to the right, there are 4 bull market scenarios and 4 bear market scenarios. There's 8 total cases, 4 bull and 4 bear. Notice the common denominator in terms of earnings under all of the bull market conditions compared to all of the bear market conditions. In bull markets, earnings is doing what? Rising. In bear markets, earnings is doing what? Falling. See how this is tying back to the data that we presented to you? All right, so we track it closely. The truth chart is a great way to just kind of outline how we track it for you. But in a case 1, that is when bull markets begin, and it's at the very first inclination that stocks are starting to turn the corner on earnings. Does anybody remember back to March? We're going to go through a case study here. But does anybody remember back to March of 2009? It was Citigroup. The banks were under tremendous pressure, right? We're at the back end of, well, we didn't know it at the time, but here we are in a financial crisis, and little old Citigroup comes out and says, hey, guess what, guys? We turned a profit in the first quarter of 2009. And the stock market took off like a bird. So it's under that condition, the first inclination that stocks are beginning to turn the corner, that bull markets begin. We already discussed how they thrive, and that's going to be when interest and inflation are moving lower to help catapult those stronger earnings, right? And that's usually a pretty short sequence, honestly, because then the Fed needs to try to cool the economy, right? So we have case 3. That one rarely happens, but when the bull market ends, you know, you stay a long time in case 4. A long time. It can go on for years and years and years. In fact, we've been in a case 4 predominantly for, gee whiz, since maybe 2010 or 11. I'd have to go back and verify to make sure. But, you know, they can last an awfully long time. But we have a situation where earnings is rising, inflation is rising, interest rates are rising, but we still have prices continuing to rise. So what we need to know is what to look for in terms of when is the bull market, the bear market coming, right? And so bear markets begin at the first inclination that earnings is really beginning to suffer across the board, okay? And a key word here would be perceived. And so what are a lot of people talking about on CNBC and things like that right now? Well, Apple kind of, you know, Tim Cook came out 2 nights ago after the market and said, what about their forward guidance for Apple? Beginning to guide lower. Now, that's just one company, right? And so it's important that we don't get too focused, again, on relevant information, but just for a single company, but we focus on the global stock market, okay? But it's important because what did that shock wave do, at least for a moment, until people realized, you know what, nothing's really changed. We already knew that. What's happening today, at least last time I looked at the futures this morning? They were up big time, okay? But the whole key is to keep focused on earnings. And if it's more than Apple, you know, if a lot of companies begin to suffer and it finally hits the bottom, listen, the news is one thing. When it finally hits the bottom line, that's when it really matters, okay? That's when it really matters. All right, so that's important data. Bear markets begin when the economy is strong, inflation and interest rates are high, and earnings are expected to fall. So again, inflation and interest rates can rise. You know, that's a sign of a strong economy. It's when they get high, and that's the tricky part, as to when earnings are then going to be expected to fall. Okay, so we got to keep our eye on inflation. We got to keep our eye on interest rates. Now, he wrote an essay back on November 2nd, 2007 that was called Buying Contra ETFs. I'll never forget this. I was at a AA show here in Florida with Dr. DeLito. Dennis, were you there? I may have been. I think Dennis might have been there. We were telling everybody we could that a bear market was coming. Everybody we could. And people just kept shuffling by the booth. They said, you guys are on the moon. Here we are, the market's been running and chugging along, you know, for more than 5 years. And you guys are going to sit here and stand here and tell me a bear market's coming? Well, earnings, we started to see earnings enter into what we call a failure rate. Earnings were already starting to tip. Okay? Now, it would be a couple of months into February of 2008 before the investment climate would first signal bear market is underway. But we saw that that was going to happen. And so it's important that you stay in tune with VectorVest and that you read. How many people read the VectorVest views? All right, I'm trying to memorize. Now, if I was going to grill you and ask you some questions, how many people really read the views? Yeah, see, I wish Dr. DeLito could have seen that. Only about half of you raised your hand the second time. Read the views, guys, because this is the kind of information you're going to get from us on the stock market. I wrote an essay about buying contra ETFs and warned readers that yesterday's confirmed down signal could be the entree to a long bear market. We're not there yet because earnings are still rising according to our method of analysis. But do not be deceived by the endless parade of experts that will appear on TV and other places telling you to buy stocks. Now is not the time to buy stocks. In fact, we were telling you to buy contra ETFs. And think about how much money. Contra ETFs are instruments that you can buy along, and when the stock market plummets, they go up. In fact, they skyrocket if you start playing with leverage. I suggest you don't start with leverage, but you know, that's the whole point. And so this is where we signaled it. Look at this chart. And look at the market performance all the way down until little old Citigroup down here at the green arrow. Little old Citigroup says, hey, guess what? Earnings are no longer falling, right? We're starting to, believe it or not, produce a profit. And that's when the stock market took off. So bull markets are born when the economy is weak, inflation and interest rates are low, and earnings are expected to rise. On Friday, March 6, 2009, the world was gripped, in case I need to remind anyone. On March 2009, the world was gripped in a financial crisis of monumental proportions. Did anybody else feel like you ought to take a little sum of money and just stick it under the bed somewhere? I mean, what good is it going to do you? You know, that was kind of the situation that we were in. At least that's the way it felt. Has anybody ever heard of a guy named Warren Buffett? Anybody ever heard that name before? When does he say to buy stocks? When blood is in the streets. And I can tell you, blood was in the streets here in a way that we had hardly ever seen before, okay? you'd have to go back to 87 and then back to, 50 years prior to that to see anything of this kind of substance in terms of economic crisis. The S&P was down 57% from its all-time high of 1,265. Investors were looking for any hint of good news. Little old Citigroup. 651,000 non-farm jobs were lost in February, and the unemployment rate was 8.1. Now, unemployment rates have gone higher than that historically, in excess of 10% at times, but 8.1 was a tough rate. On Friday, March the 6th, 2009, he wrote another essay called Itching to Rally and said, we would go along with one of the following strategies if an explosive rally occurs. Notice the names at the bottom there. Bleyer's bottom feeders, bottoms up, jailbreak, Pirates long. Where's Dave Silber? Where are you, man? Silber's singles. He's famous. He wrote one of the 5 strategies we were thinking about buying stocks with. And had we bought his strategy in 2 weeks, the stocks were up more than 40%. We bought jailbreak. It says here on March the 9th, as we get deeper into it, on March the 10th, news came out pre-market that Citigroup made money in the first quarter and the market exploded. We went long with jailbreak, and the reason we went long with jailbreak, those stocks were up 24% on the day. They were up about 17% that morning when we bought them. They were just exploding. Citigroup was one of the stocks in jailbreak, by the way. There were some big names in that jailbreak strategy at that time. And here's the resulting price activity in the stock market afterwards. So that's when bull markets begin, folks, when things look really bleak, maybe even of monumental proportions, and companies start to announce, hey, guess what? We finally turned the corner. That's when they take off and start to explode. Okay? So the current situation, the U.S. market is in a case 3 bull market scenario in which earnings and interest rates are rising while inflation is falling. Now the 8 cases that we went through in the truth chart, one thing I failed to mention is that you don't necessarily move through those cases sequentially. You can bounce around because the data is a little wild, okay? Predominantly for the last 8 or so years, we've been living and breathing in a case 4, okay? I just have to take the most recent data at the time we published the slides. And we've been in a case 3 for a little bit, but I would expect you to see move back to a case 4 before too long, okay? And so the case 4 is what? Does anybody remember on the truth chart? That's when the bull market ends. Are we at the end yet? Who remembers, because it was in the presentation, if you were paying attention, are we at the end of the bull market yet? No, because why? Earnings are still rising, according to our method of analysis. But it's going to be critically important to keep our eye on 2 things, and what were they? Earnings and inflation. Because at some point, they become a problem. But the good news? Not yet. And so what you have going on right now is a lot of fear and uncertainty because people aren't as smart as you. They haven't come to a VectorVest seminar. Okay? In the end, and I don't know when it's going to be, but in the end, you have to eventually go back to the facts. You have to eventually go back to the facts that earnings are rising, and while interest and inflation are also rising, they're still relatively low. And so I leave you with good news. And let's see if we've got our outlook. The bull market will continue as long as it's perceived, notice the underline, that earnings are rising. And so what's on the horizon here just a couple of weeks from now? Earnings. And so now is going to be a good time to be plugged in and watching those earnings and stay focused. Stay focused on the bottom line. Because again, earnings is the key, right? That's the big picture. We want to make sure that earnings continue to rise and read the VectorVest views because when it's time We'll let you know when the market's we're monitoring this stuff for you, okay? So just stay into the views, stay focused. We'll let you know when the next bear market is here. It is not here yet. And with that, I'm going to bring up Jerry, and he's going to show you how to tactically take advantage of this information that we just presented.
Faster, smarter, better trades? You're just one tap away with the VectorVest mobile app. Just create a watch list of stocks. With one tap, VectorVest automatically rates them for value, safety, and timing, marks them buy, sell, or hold, and ranks the list from best to worst. Just one tap. The all-new VectorVest mobile app. Free for 2 weeks. VectorVest. Clear direction in the palm of your hand.